Should I do a DSCR loan, or should I get a hard money loan for this particular property? I just want to make this very short yet informative video as far as which would be the most appropriate loan product depending on the scenario. A hard money loan, when do you typically use that kind of product? Well, that's going to be when you, the investor, is looking at quickly acquiring a property. Typically, it's going to be a short-term loan anywhere between 6 to 12 months, and you're going to typically fix it up, renovate it, put a tenant in place, rent it out, and then you're going to refinance, rinse and repeat. Now, you can also just do a straight bridge loan, and simply all that is a fix and flip loan minus the rehab component. So you're just essentially making a very quick acquisition, and you're only going to be paying interest only for 6 to 12 months until you exit out of that deal, whether it's by selling the property or refinancing, just like a normal fix and flip deal. Now, on the other hand, when it comes to a DSCR loan, this is going to be a more what's coined long-term debt product. Typically, it's going to be 30 years. Most of the time, it's going to be fixed, or it could be an adjustable rate mortgage where you're going to be paying not only interest, but you're also going to be paying down the principal balance of that property, and that's going to be amortized over, once again, 30 years. So the question is, which loan product is going to be most appropriate for your deal? It's going to depend on the deal. Now, I'm not going to paint every single deal scenario you come across with a broad brush, but I will make a generalization. The generalization I'm going to make is this: if the property has deferred maintenance, it's not really in what you would consider a livable condition, and it needs to be rehabbed, you know it's going to need some renovations, and you definitely plan to sell the property, you need to get a hard money loan so you can fix and flip it up. On the other end, if the property is basically rent ready, maybe it needs a light touch of paint, maybe a couple of new appliances, but overall it is rent ready. Hey, it may even have a tenant in place currently leased making payments. Well, in that case, you don't need to borrow hard money and rehab the property. You just need a long-term DSCR loan. Obviously, you're going to have to take more things into consideration as far as the taxes, the insurance, the homeowner association fees that are monthly, if that applies. You need to make sure that the market rent or whatever the property is leased at currently covers the debt at a certain DSCR that the lender that you go to or the mortgage broker that you work with will find attractive enough to give you the best rates and terms on and lend you the money for. So that's really it. That's the difference. A hard money loan is typically going to be short term. You're going to have the intention of quickly acquiring the property. Most people renovate it, and then you're going to either sell it or refinance. A DSCR loan is going to be typically rent ready. Sometimes it's already occupied with the tenant. That's a plus. And you're going to secure that long-term debt, paying down the interest and the principal balance of the loan. That's going to be amortized over 30 years, and the gross market rent or what is already leased at is going to cover and service the debt. Hopefully I've cleared the airways as far as any kind of confusion as far as which loan would be best suited for your situation. But hey, if you are an investor and you're eyeing either of these scenarios, please give us a call, 706-536-3598, or you can also shoot over your scenario to me at joseph@powercapitalsolution.com. Either way it goes, thank you so much for taking the time to watch this video. Happy investing.